Hi, Assalamualaikum everyone. My name is Nabil Ihsan bin Kamara Arifin from Group 1. Alongside with me is Ahmad Fikri, Dini Liana, Fatin Nadia, Putri Noliana, Nur Kristina and Daiki Ichikawa. And today we're going to discuss about the report from Business Finance that we already made. This topic is to analyze the current financial position of the company and performance, to analyze how to improve the financial position for the prospect of your company, and to evaluation and the conclusion. For the introduction, we need to analyze annual reports for Aeon from 2021 to 2023 in order to gain a comprehensive understanding of the company's financial performance and trajectory over the past 2 years. This analysis involves delving into various financial statements, including the income statement, balance sheet, and cash flow statement to assess key financial metrics and trends. Although we conducted all types of calculations, because of time restraints, we can't answer all of the questions. The goals of this project is to figure out the company performance and to figure out the way to improve the financial position and performance for Aeon Berhad.
Assalamualaikum, my name is Fikri Ramazan and I'm going to present on financial ratio. For company Aeon current financial ratio, the company has total asset of 5.2 million and total liability of 3.3 million. So from this we can calculate the equity for Aeon company using formula of total asset minus total liability equal to net worth. After the calculation, we get 1.8 million of Aeon company net worth. Ratio is liquidity ratio of Aeon company. In liquidity ratio, we have 5 ratio. First of all, it is current ratio. Its formula is current asset divided by current liability. Over time, the current ratio has changed from 0.5 to 0.51 times, indicating a relatively low degree of liquidity. Companies should increase current assets such as cash reserve, marketable security, and short-term investment and focus on managing current liabilities effectively. For example, they should renegotiate payment terms with supplier and improve inventory management. So on the right side is the second ratio in liquidity ratio. It is acid test ratio or known as quick ratio. Its formula is current asset minus inventory divided by current liability. So Aeon company recorded the highest quick ratio in 2022 and 2023. From 2021 to 2022, the ratio increasing in 2023. Aeon company had static quick ration in 2021 and 2022. It shows that the company has the ability to pay off debt promptly. Third formula in liquidity ratio is average collection period. To calculate it, we use account receivable or debtor divided by daily credit sales. And Aeon company recorded the highest average collection period in 2023 with 314 days in 2021. Aeon company had collect its account receivable in 302.74 days. It's keep increasing to a year 2023 with 314.60 days. Next is account receivable turnover. We use formula of annual credit sales divided by account receivable. And Aeon company account receivable were turning over 0.65 times in 2021. Account receivable shows an decreasing in 2022 with 1.18 times per year. In 2023, it keeps decreasing with 1.17 times a year. It shows Aeon company that the shorter inventory cycle lead to greater liquidity. And last formula for liquidity ratio is inventory turnover. In order to calculate that, we need to use COGS divided by inventory. Aeon company inventory turnover is 3.62 times in 2021 but increased in 2022 at 3.99 times, leading to a good movement of inventory management efficiency. also has recorded an increase from 2022 to 2023, resulting in the rate of inventory management efficiency has increased. Next ratio is capital structure ratio. In this ratio, there's only two formulas. First is debt ratio. Its formula is total liability per total asset. In 2023, it decreased from 66.70% in 2022 to 28.7%. I think this is a very good trend. It's clear that the company doesn't finance itself with a high proportion of debt. A better option is to raise additional equity capital through the issuance of new shares and retained earnings. This could increase the share of equity in the capital structure and lower the debt to equity ratio. And the second ratio is time interest earned. Its formula is operating income per interest expenses. The time interest earned for the company increased every year from 24.70% in 2021 to 30.8% in 2022 and finally 32.62% in 2023. The increase of times interest earned shows that the company is getting more capable to cover its interest expenses with its operating income. This signifies improvement on financial health and stability because the company has more earnings to meet its debt. And that's all for my part. Thank you.
Okay, evolution from financial ratio. Asset management efficient ratio of Aeon. Total asset turnover equal to sale per total sales. The total of asset turnover for Aeon BHD increased every year from 2021 until 2023. The total asset turnover increased by 0.14 from 2021 until 2022 and 0.03 from 2022 until 2023. This shows that the company is efficient in generating income from their sales or their revenue. Fixed asset turnover equal to sales per net ton and equipment. From 2021 to 2022, the fixed asset turnover increased by 0.23 and it decreased 0.09 from 2022 to 2023. This shows that the company managed their fixed asset investment properly at first. However, a year later, their fixed asset that has lost their efficiency.
Next is receivables turnover. For this calculation, we need to use formula of credit sales divided to account receivables. The receivables turnover of Aeon Co. M. Berhad increased every year from 7.61 times in 2021 to 13.73 times in 2022 and lastly at 14.17 times in 2023. This shows that the company received payments from their company more quickly, so it can improve their cash flow and reduce bad debt in the company. Last ratio for asset management efficiency is the inventory turnover, which is we use the formula of COGS divided inventory. Inventory turnover for the company increased every year from 3.62 times in 2021 to 3.99 times in 2022 and lastly 4.30 times in 2023. This shows that the company is selling its inventory more efficiently every year. Next ratio is profitability ratios. First formula is gross profit margin, which is gross profit divided by sales. GPM has been decreasing since 2021, dropping from 7.19% to 7%. In other words, for every 1 ringgit of sales, the company spends 0.93 ringgit on cost of goods sold. Measures will need to be taken to keep costs low. For example, we can streamline our supply chain to shorten lead times, minimize transportation costs, and optimize inventory levels. Next ratio is operating profit margin, which is OPM, and the formula is net operating income or EBIT divided by sales. From 88.4% in 2021 to 85.4% to 2022, this ratio decreased around 2.5%. Also, it dropped to 83.4%, which shows the company's profit decrease. In order to overcome this difficulty, we must consider how to decrease COGS. As an example, it's necessary to negotiate with suppliers. Next ratio is net profit margin or NPM. The formula for net profit margin is net income divided by sales. Aeon Berhad net profit margin is increasing annually from 2.35% in 2021 to 2.69% in 2022 and next 2.78% in 2023. The higher the NPM, the more profitable the company is. Aeon Berhad is able to effectively control costs or provide goods and services at prices significantly higher than costs. The fourth ratio is operating return on asset, which is net operating income divided by total asset. Operating return on asset or ORA for the Aeon Berhad increased every year from 5.48% in 2021 to 6.51% in 2022, and lastly 6.6% in 2023. The company is more efficient and productive at managing its balance sheet to generate profits. This is a good indicator for investors and to invest in the company. And the last ratio is return on equity. The formula is net income divided by common equity. In 2021, the percentage was 4.89%. Then in 2022, it was 6.16%, and lastly in 2023, it was 6.18%. This means that net income increases every year, and it shows that the company is more effective at generating profit from its existing assets.
Market price per share, price earning, PE ratio equal to market price per share per earning per share. It has decreased from 23.23% in 2021 to 16.13% in 2023. Given the investors are paying their RM16 for a profit of RM1 ringgit, it can be assumed that the company growth is declining since profit have increased even when calculated from 2021. It can be said that the cause is intensive competition due to the entry of new companies and overall recession in the industry. Improvement measures include increasing market share that can lead to higher sales and higher profits, which can have a positive impact on PE. This can be achieved through effective marketing strategies, product innovation, and customer retention efforts. Okay, next, market to book ratio equal to market price per share or per book value per share. The result that in 2021, 0.79% increased to 0.82%, but in 2023, it dropped down to 0.79%, which means due to below 1, the market is considered pessimistic because stocks are valued below book value. In order to improve this, we have to increase profitability. The focus should be on improving the company profitability by increasing revenue, reducing expenses, and optimizing operational efficiency. Increased profitability will lead to increased revenue, which can positive impact on the market value of the company.
Improvement that we can do to improve company business is increase assets current such as account receivable and inventory, keep current debt ratio, cut off more expenses, consider through effective marketing strategy, product innovation, and customer retention effort. In conclusion, the strategy should focus on increasing current assets like cash, account receivable, and inventory to improve liquidity and flexibility, while maintaining a healthy current debt ratio for financial stability. Stock management should be improved to optimize inventory levels and reduce costs. Efforts to cut expenses will improve efficiency and profitability. Effective marketing strategies, product innovation, and customer retention are crucial for future growth and market competitiveness. That's all from us, Group 1. Thank you.